This week in real estate with the J Harmon Home Team, got a special impromptu episode this morning. I'm Trent Denson, part of the team here. Got our fearless ops boss, Michelle Reeves, with us. And of course, our favorite mortgage lender on the planet, Bryan Nale. How are you, sir?
I'm fantastic. A little Taylor Swift hangover this morning,
Yeah,
but
the,
otherwise fantastic.
the old very early arrival from the 4 hour rain delay out with all the Swifties last night. But we're pumped to have you here, sir.
Glad to be here.
Yeah, man. So we were talking a little off mic about just how there's some wild things being said about the mortgage industry right now, and we're here to kind of, as you said, demystify the loan app or just the mortgage application process, and just talk about some of the stuff that's happening with the Fed and rates and all the things, man. So I guess where should we start? Where would you like to start?
Well, I think the big topic right now is, hey, I hear that somebody has a lower credit score is going to get a better deal.
That's a great place to start.
And
How in the world is that a thing?
Well, we'll leave a lot of that kind of for sidebar discussion.
Okay.
But I do want to kind of address a couple of things with that.
Okay.
And one of those being that I've had a client ask me, should I skip a credit card payment so I can get a better deal on my mortgage? And the answer, if you're watching, is no. No, please don't do that.
A resounding no.
That's not. That's if you're reading that way. If you're reading it that way in the media, then and I think it's kind of designed for you too.
Mm-hmm.
The wording and everything that I've read has been very clickbait oriented and like audacious headline, an audacious Facebook post, and click this and read this, get outraged by it kind of mentality.
Yeah, never seen that before.
Well, I mean, and you talk about like, this network spread the positive.
Yeah, right.
So let's
stay on
some
that
positive
side.
vibes out there with this. I wish more I wish there were more positive outlets, but
right.
A lot of times people just feel like to generate clicks and shares and reads and eyeballs on content, you got to put a spin on it that makes it sound negative. And
that's true.
At the end of the day, with all of this, if you have a lower credit score and you're doing a conventional loan, you're going to have the choice. You can do FHA, which has been there all along for people with lower credit scores or maybe higher debt to income limits.
Right.
Or now you can do conventional, and you can do conventional, and you could have done conventional before. The only thing that's changed now is that it's not going to, the penalties for you having a lower credit score just aren't going to be as severe as they would have been prior to this change.
Okay.
And by the way, this change has been in place for a long time. Like it went live for loans delivered to Fannie or Freddie after May 1st.
Oh, wow.
So May 1st was just last week, right?
Right.
But loans that were locked in March, loan applications that were going under contract, people buying homes and locked in March, their lenders were already pricing this in because there's a strong chance if you lock in March, you're going to close in April. It's probably going to get delivered to Fannie Mae in May after May 1st. So this was something that caught everybody's attention as that May 1st date drew near. But the people reporting it didn't really understand that this was announced in February. It's kind of old news for most mortgage lenders,
right?
And a lot of realtors who kind of were in the know and knew this was coming. But then once it kind of caught a lot of headway and a lot of attention, it became just a buzz.
Yeah,
about 2 or 3 weeks ago. So I would tell you, if you've got great credit, you're gonna either have a choice to pay a little bit in points and keep the rate that you would have gotten otherwise, or pay a little bit higher rate. You just talk with your lender and understand what your options are. There's nothing anybody can do about this change, although there's some lobbying going on right now from the National Mortgage Bankers Association to kind of bring light to the impact of this,
right?
And have some conversations about, does this really help homeowners or home buyers with affordability?
Yeah.
When you've got FHA, you've already got a program there that's designed for them. Do you need to make it less affordable for somebody with good credit? Because the big thing that I would say is, just because somebody has good credit doesn't mean that they have more income.
Right.
And if somebody,
that
those things, they can correlate, but they don't necessarily have to. There's a lot of people who are getting by as best they can, but making sure they pay their bills on time and have great credit scores. So
yeah, I was about to say, some of that actually sounds like it makes sense.
Yeah.
There's parts of it there that when you explained it, I'm like, well, given the current state of things and the way things have been, that might make sense to a certain degree to have a little more flexibility in those ways. But again, the sensationalization of the headlines and all the bad stuff, and just if you got a lower credit score, you get a better mortgage. Like that's not how that works. But okay, all right, demystify.
It basically it takes the gap and it just shortens the gap between the lower and the higher credit scores. So it just kind of it shortens that gap.
Which in theory would be good, right? My economic brain's not always fully there, but
Mine neither.
It depends on where you're looking at it from.
Yeah.
If you're looking at it from, hey, we've done everything right. I was able to get this, these terms, and now my terms are a little bit worse.
That side of it.
Then no.
If you've really done it right. Okay.
And this is my personal opinion. It's not the opinion of the company I work for. It's not the opinion of anybody other than Bryan Nale. But there's already a solution through FHA. FHA reduced the MIP, the PMI rates earlier this year to make home ownership more affordable for people with lower credit scores. So there's already a vehicle, there's already a vessel.
There you go.
For people with lower credit scores. So
yeah, okay.
What are we doing with this? There's questions I have there.
Got you.
What is considered a great credit score?
Well, that's a good question.
I mean, you can pull it up online, but I would rather hear it from you.
And I wish a girl that I work with, Taylor West, she talks about this a lot, and I wish she could be here to answer this question. But if a credit score qualifies for mortgage, it's a great credit score.
There you go.
That's
a good answer.
Okay.
There's a lot of different ways that we can structure your mortgage and get it set up so that you get the best terms available to you. But you need to have a 580 for FHA. There's even some cases where you can go lower than that, but generally speaking, 580 is going to help you to get into an FHA. And I don't think most people would say, hey, if I have a 580 credit score, I've got a great credit score.
No, I wouldn't think so.
Mm-hmm.
But it's good enough to get you in a home if you have some other things going for you.
Right.
If you have some other things and you've got some strength in, then yeah. And
what are some of those strengths?
Yeah, reserves.
Okay.
Because one thing that anybody should want to do is buy a home and have $0 left over after closing.
Right.
Because you're gonna have down payment, you're gonna have closing costs. Sometimes you can get the closing costs covered by the seller. You can do a rural development loan, or you can do THDA, some down payment assistance programs where you could literally come to the closing table with very little money out of pocket, if any at all.
Right.
But if you have $0 left in the bank, and the first month that you're in a house, you have to service the HVAC unit, or the water heater goes out and needs to be replaced. You don't just call your landlord and say, hey, the water heater's busted.
Right.
Yeah, that goes away.
That's on
you. You are the landlord.
Yeah.
So having some reserves is and that's not why the automated underwriting systems look for reserves. They don't care about that. They want to know that if you miss a paycheck, you can make the next payment.
Right.
Because you may have an injury or go out on an unpaid vacation or unpaid leave for whatever reason. Do you have enough reserves if or an unexpected expense? The car breaks down and it's going to be $800 to fix the car.
Right.
Can you handle that within your budget?
Yeah.
So some reserves could be a mitigating factor or a compensating factor to help lend strength. Others could be low payment shock. So like you've been paying $1,800 a month in rent and your mortgage payment's only going to go up to $1,900.
There you go.
You're not really having a lot of shock to your monthly budget.
Right.
Those are just a couple of examples.
Got you. And as far as just go a little deeper into what Michelle asked, like, I guess what are the new thresholds like beyond kind of the entry level first time stuff? Like what is someone with a more established credit history like? What are those thresholds looking like?
So the first thing that I'll go to, the first number is 640.
Okay.
Because if somebody has a 640 credit score, they're going to be able to do rural development. They're going to be able to do THDA. THDA is huge right now.
Right.
THDA's rate is running at 5.5% right now. Change it any time, but right now you can get into THDA with a super low interest rate. If you are a veteran or have some other qualifications, you can even get a THDA down to 5%.
Wow.
So that 640 is a big benchmark for me, especially when I'm looking at first-time home buyers. Because
Nice.
some of those first-time home buyers, they need to have a little bit of help to get
Yeah,
in.
100%.
And, when we talk about the mortgage process and demystifying that, one of the first things that I always do when I'm talking with somebody who's a first-time home buyer, or maybe it's been a while since they've gone through the mortgage process, is
That would be me.
Yeah, right. Yeah.
I think of qualifying for mortgage as like a three-legged stool.
Mhm.
So if you've got two of the legs that are the same length, but one of them is a little shorter, you can take a piece of cardboard, and you can kind of plug it,
Yep.
prop it up a little bit to get that stool to balance.
Right.
But they all need to be relatively close, and
Yep.
you need to be pretty close on all three of these stool legs.
Right.
And the first one of those is credit. So we've kind of already talked about that a little bit. And then, the second one is going to be ability to repay. And ability to repay is what's your debt to income ratio. And we look at your gross income, what you make before taxes, before insurance gets taken out of your paycheck, before your 401k gets taken out of your check, your United Way contributions, if you're doing that through payroll deduction.
Sure.
Basically look at what you make before all of those expenses are taken from your paycheck. And we don't want more than 45% generally of that money going out towards your new mortgage payment plus your other debts. Now, there's like FHA will go up a little bit over 55%. So 45 is not a hard and fast rule, but from a comfortability standpoint, that's a general good rule of thumb.
Okay.
And really, you don't want that mortgage payment to be more than 29, 30%. Now, there's always, I may calculate your income, and y'all may be getting a mortgage togetger. And I might only,
Hey,
I
Rooney.
might only want to use
go
Trent's
invest in
income
something,
because
Why not?
because
Seriously, that'd be
for whatever
great.
reason. But or maybe let's say Michelle's got great credit, Trent's got bad credit, right? So I look at your household and I say, well, your household income is completely fine,
Right.
but we're bumping up against that 45% debt to income ratio because we're only using Michelle's income information because you're not going to be on the mortgage.
Gotcha.
So in those cases, we're not going to. There's income there that we're not counting
Right.
in the application. So we might be right at the limits on the debt to income ratios. We might have you at 56% trying to go FHA. And if it gives some approval, I'm not going to feel bad about putting you on that house because I know that Trent's making money on the side too that we're just not counting.
Right. Right. That's cool.
So there's the two,
Yeah.
ability to repay. And then we've got the
Credit.
And then the third one is skin in the game.
Yep.
How much skin do you have in the game? And that's where
Assets.
Yeah. Well, down
Or
payment.
Down payment. Gotcha.
And like I said, the THDA, there's two different options. You can get a grant for 6% of the purchase price that you pay back on a 30-year amortization at the same interest rate as the first mortgage. So you basically you've got a first mortgage, it's your main mortgage. Typically going to be an FHA, but there is a conventional option. And then you're going to have a second mortgage that you're paying back at the same amortization. And so in essence, you're a little bit over 100% loan to value if you're doing a 6% down payment assistance second mortgage and then a 96.5 FHA loan. So that is going to cover your down payment plus give you a little bit of extra for closing costs.
Yeah, that's cool. So we're throwing a lot of acronyms around.
A lot, yeah.
A lot of acronyms. We're fairly familiar here,
Yeah.
being on the team and being a realtor. I should be pretty familiar with all these terms.
But if we're
I'm
trying to demystify,
yeah,
things,
let's
Yes.
demystify some of these acronyms. So let's start with the THDA. That's
Yeah.
I mean, my well, go ahead.
Yeah.
Go ahead, please.
So THDA is Tennessee Housing Development Agency,
Right.
and it's our first time home buyer program for the state of Tennessee. When somebody says, "Hey, I'm a first time home buyer," 99% of the time or not 99% of the time they're thinking FHA, but a lot of times they're thinking FHA. The thing with FHA is you don't have to be a first time home buyer to do an FHA loan, but
And that's federal housing.
Federal Housing Agency.
Gotcha.
Yeah.
Okay.
And that's your typical. You might have heard, hey, you don't need 20% down, you need 3.5%.
Right.
Well, that would be an FHA loan.
Gotcha.
To 3.5% on a down payment. So the Tennessee Housing Development Agency, THDA, is this vehicle that helps a lot of first time home buyers. Now I'll say this too, and I'll say it. You don't have to be a first time home buyer to do this. There's actually you can get your first time eligibility restored if you haven't owned your primary residence in the last 3 years.
Right.
So Trent might have sold a home that he lived in 7 years ago, and he can get a first time home buyer
Right.
now.
Yep.
Or maybe he's owned a home and 5 years ago he moved out of that home and converted it to an investment property. And since then he's been renting.
Nice.
He's a first time home buyer again for a primary residence.
Or moving out of state to
Right.
Tennessee, right? Like even if it's your first time buying in Tennessee, it can be
No,
Oh,
if
is
you've
that-
owned a home if you've
in the
owned your
last 3
primary
years, okay.
residence
in the last 3 years.
anywhere in the United States,
Okay.
then
That's the same thing.
yeah.
What about if you're not on the mortgage, but you're on the title
Right.
only?
Yeah, so that's something that you're going to want to talk with your lender about, and case by
Case by
but
case, gotcha.
Most of the time, you're not going to be eligible for the THD.
Gotcha.
Gotcha. Okay.
Cool. That's helpful.
Yeah.
What else? What were some of those other acronyms? We got what's USD?
Debt to income. I've been
DTI.
saying debt to income,
Yep.
but it's a lot of times it's called DTI.
Right.
So if you hear somebody say your DTI is 73%, then that means that your
No go.
monthly bills are more than they can be to get approved for the mortgage
Gotcha.
because your debt to income ratio is too high.
Gotcha.
Let's see, loan to value, we call that LTV.
Right.
So if you're here talking with a lender and you hear the word, they just say, hey, your LTV is 95%. We need to get it down to 90% for this loan to work because we're trying to do
X, Y, and Z.
X, Y, and Z.
Mhm.
Then they're talking about how much money you're borrowing versus the value of the house.
Right.
And so most of the time that's pretty straightforward. 10% down is a 90% loan to value. But what if you start out planning on buying, let's just say a $200,000 house and you're putting $20,000 down. So you're making 10% down payment, but it only appraises for $197,000. Now your loan to value ratio is off because the value is based on the lower of the loan amount or the lower of the purchase price or the appraised value.
Right.
So your $20,000 down is still enough to qualify for a mortgage, but you're not going to be at 90% loan to value. You're going to be at like 92.
Gotcha. Right. Well, cool. Let's talk about some stuff you're excited about. Premise wise, product wise, life wise, whatever you got, man. What are you excited about?
Man, let me talk about Taylor Swift last night.
I think Bryan Nale gets the biggest, happiest Taylor Swift dad award.
I saw quite a
Like
few.
he's the man.
That
Man,
post
she
that
played the man last night.
he knows.
He knows the song title.
That's a new one,
So I
man.
saw a guy that was wearing a shirt. It said, "It's me. Hi, I'm the husband. It's me."
Nice. That's perfect.
great.
And there was like Swifty by marriage, or like, I'm the Swifty dad. Not all, dads can be Swifties too.
I love
That
it. man.
sounds like a Disney
Yeah.
shirt.
That really does.
No, it's funny though. Like I got friends that, and I promise you this: if you had told me 5 years ago that I'd be excited to be going to a Taylor Swift concert, I'd have thought, yeah, you're crazy.
Yeah.
But something happened. Well, two things happened. One, Ryan Adams covered the album 1989. If you don't know who Ryan Adams is, he's a singer songwriter. He's kind of got a little bit of a checkered past and everything, but he can write a really good song.
Yeah,
And
facts.
so he was just saying he had broken up with Mandy Moore, and it was a pretty ugly breakup, I guess. And he was down in his feelings. So he was just listening to Taylor's 1989 album. And he was like, "These songs are great.
They're
And
incredible."
so he
She
tweeted
really is
at
an
Taylor
amazing
Swift,
songwriter,
"I
yeah.
want to cover your album." And so she tweeted, and he didn't know if she'd even see it.
Yeah, right.
She tweets back, and she's like, "Oh my god, that'd be amazing! Like that's so cool."
That's so cool.
So he covered it like his style.
Yeah.
And I started listening, but hearing the music presented in that way,
Yeah.
like I put more focus on the words,
Mhm.
and I was like, man, these
They're
songs
deep.
are
Yeah.
great songs.
I know.
Yeah,
And
they
she-
truly are.
And guess what? She writes them. It's not like a
100%,
songwriter
yeah,
team.
yeah.
She writes that.
And
stuff.
the other thing that I have to say about Taylor Swift is she's got fantastic business acumen.
Oh,
Oh,
yeah.
I mean,
yeah.
hands down.
Yeah.
She's a rock
You can
star.
make fun of her music all you want and hate on it, but she's
She's a billionaire.
Yeah.
Literally.
And
Or
Yeah.
about to be.
Yeah. So the
So-
second thing that happened was my daughter, man. Like,
Yeah, that
she
post
just-
you posted
yeah,
about just
Yes.
it was worth it.
She's fallen in love with the songs, and I've always been a loud music.
Oh,
guy.
yeah.
Like,
I know you're a
love
big
going
music
to
guy.
shows,
Yeah.
and so this was just one that I wouldn't have thought that I'd ever really check this one off the list, but we had a blast. Just it was unfortunate with the rain delays.
Yeah,
We
man.
couldn't stick around for
I
the
hate
whole
that.
show, but we still got home after 1 o'clock.
That's wild.
this morning.
Yeah.
Yeah.
She's a rock star though. I'm glad. And your post just really hit home. You're like,
Yeah.
this is it. Like
Yeah.
it was worth sitting there for 4 hours,
Yeah.
doing the
Yeah.
monsoon,
Yeah.
putting up with everything, getting home late for this
Yeah.
moment right here. So I
Yeah.
appreciated that a lot.
That video of
Yeah.
her just
I
bouncing.
mean,
And like if you notice, if you watch it, like it's the first song that Taylor comes out and does, and Errol just got these earplugs in and stuff, and she's like, no. She pulls it back.
need to be
That's
fully
great.
present for this one.
Yeah.
But no, product wise, the Primis, I just got a cool story, and it's actually a transaction that Jonathan and I did together.
Nice.
And it was
Keeping it in the fam here.
Yeah.
Let's go.
Well, and what happened was he sent a client to me, and not real sure if this client's going to use us or maybe use me and a different realtor or maybe use a different lender. And Jonathan, we weren't real sure. They were very clear, transparent. Hey, we're shopping, and we want to find out who we're comfortable with, and that's great. Man, you should.
Yeah.
Everyone should do that.
Yep.
Now we want to earn their business. That's our goal, right? We want to stay in that transaction with them. So they wanted some acreage, and they found a mobile home. And at that point in the process, for me, most of my career, the conversation would have stopped, and I would have had to say, let me give you my contact information with a friend at another bank that can do that transaction for you. I'm out. And so, but not here.
Nice, dude. Look at that smile. That's a big smile.
Not where I am now.
Right here. Very excited.
So
that's awesome.
But I was able to send that listing over to Jonathan and say, hey, this client asked you about this property, and he said, man, that's a mobile home, dude. I was like, I know, let's go. We can do that.
Oh, snap.
And he was like, really? I said, yeah, we can do that. So that's another demystifying nature maybe of the mortgage process. A lot of lenders have overlays that get very tight and restrictive around doing mobile homes, but we're seeing more and more people wanting to buy mobile homes in this market because we're getting pushed out of the urban communities and into more rural areas to find more affordable housing. And a lot of times that more affordable housing is going to be a mobile home. So by us being able to stay in that conversation and Jonathan being able to go show them that house, knowing that we had a lender that didn't have the overlays, an overlay is where Fannie or Freddie or FHA or any of the major loan options will allow something, but the specific lender that you're working with has an overlay that says, well, we can't do a mobile home unless it meets this X, specific criteria.
Right.
Or, you may have an overlay regarding a loan to value or a debt to income, just more specific rules that lenders follow.
Yeah.
And so by us being able to get Jonathan out there to show them that house, they didn't write an offer on that one. They saw another mobile home a week later that they wrote an offer on, but they didn't get the house. And they found a stick built home. They found like a regular stick built is just like your standard home. And they found one, they wrote an offer on it, they got the house, and we closed.
That's awesome.
So we've got this, that's one story of
but just being in the conversation still makes that
right. We didn't have to outsource that to somebody. And most of my career I've had to do that.
That's awesome.
And I've got some we're blessed in this community to have a lot of great lenders. And so there's a lot of options for people to work with and talk to find who you feel comfortable with. But you also want to make sure that regardless of where you go with your transaction type or purchase, property type, you're going to have somebody that can see it through to the end with you.
That's huge. It's huge. What else, man? What else are you excited about Primis wise? I mean, that's got to be huge, but I mean, you can see it. Like you're fired up. You're fired up about new stuff that you can do and all that. So,
to me, it's all about client experience and this customer obsession that we have at Primis of just, putting our clients first and giving them an excellent experience. Man, we get things through underwriting so fast.
That's awesome.
And it allows us to, if there's an issue that we uncover in underwriting, we don't find out about it 3 weeks into the transaction. We find out about that really quick. We get out in front of it, we fix it. We have time to respond and find other ways to set something up when we can.
Yeah.
So, and part of that, is the technology piece of it. Our app is awesome. So if you're watching this and you're a realtor and you want to know a little bit more about that or take advantage of it, maybe you're a realtor that works with us and you're watching and you're like, man, I keep hearing this about the app, but I haven't really played with it. Pull it up, download it, and and spend some time with it because you can do some really cool stuff with it.
Is it just Primis Mortgage app or?
It is, yeah, Primis Mortgage. So there's a lot of different Primis apps because
Yeah.
there's the banking channel thing
Right,
too. So
right.
you want to make sure that you get the Primis Mortgage one.
Okay.
And really the best thing to do would be reach out to me
Okay.
or any of the other loan officers on our team that you might want to work with, and
Right.
we can share a link to you so that when you download it, you don't just have the app. It's
like-
it's co-branded.
We
We can go into co-branding where like when Jonathan's client gets in the when we order the appraisal, there's a video that goes out and it's got Jonathan's information on it too, and it says, hey, here's the appraisal process when we get conditional approval. So like one of the things I wanted to kind of talk about was what happens.
Yeah, let's do it, man.
Through the loan process.
Yeah, let's do that.
So let's see, you've done the application. We've talked about your credit. We talked about that 3-legged bar stool and,
Yep.
and everything balances and you're pre-qualified. At this point, you get to go out and go shopping.
Yep.
And hopefully you can have some fun with that process and experience because you kind of have a good idea. Like part of the pre-qualification process for me is to do a consultation. A consultation so that if you buy at this price point, you can expect this much cash to close, you can expect this much monthly payment, and you're comfortable with those numbers.
I think that is brilliant.
That allows you to hit the market with some confidence,
Yeah.
Right.
and not be like, oh, I really like this one, but man, it's like $10,000 more than we wanted to spend.
Right.
Is that going to break us? If I hate it when people maybe let the perfect home go over $5,000, $15,000. So we've had that consultation. So hey, we're
Sure.
only sending you your letter for 500,000, but really, if you want to go to 525, you're going to be able to.
But don't be getting crazy.
Well,
It's not an extra 105,000.
Yes.
a big complaint that I get is that people say, a lender sent me a pre-qualification letter for 500,000, but I told them I only want to spend 350.
Yeah.
And it's like the lender's pushing them towards a bigger payment. So if you want to spend 350, I'll send you a letter for 350, but I'm going to make sure that
Yeah.
if you see with the perfect home and it's 375, don't be afraid.
That's
Call me.
huge.
Let's talk about those numbers.
That's huge.
Right.
Don't let the dream home slip by because it's a
5,
little bit
10.
more than the original budget.
Yeah.
Sure.
So we've done the consultation. You find a house, you write an offer. Who knows how many times you have to go through that process. But once you get that offer accepted, at that point, we're going to look at the rates for that day because a lot of times, and especially in a market like this, you don't necessarily want to do one of those lock and shop programs because rates they're still really volatile.
Mhm.
A lot of movement up and down, but there's more kind of downward pressure on rates and the expectations this year. So once you're under contract, we're going to look at your closing date and we're going to see what the rates look like for that. We're going to go through the conversation of should you buy the rate down. So buying the rate down is there's 2 ways a lender will make money, and it's a for-profit business, right? We're not a nonprofit. We're either going to make it in fee income or we're going to make it in interest rate spread. So in exchange for getting a lower interest rate, you may pay a little bit of extra money in the form of points to buy the rate down.
Right.
And so, people come in all the time and like, yeah, well, you quoted me this rate, but man, I got this rate over here. And we're like, well, show us the estimate. And then we look at the estimate and we're saying, did you know that you're paying $12,000 in points to get that rate? That rate sounds real good. And when the lender's telling you we can get you this rate, it sounds so much better than the rate that you and I have talked about.
Mm-hmm.
But, I can get you that rate too.
Yeah.
Most of the time.
With $12,000. Yeah.
If you want to pay those points, we'll do it.
Yeah.
So just because you can do something doesn't mean you necessarily want to all the time.
Yes.
So we have that conversation.
Mhm.
That's a good motto for life, actually.
Yeah. Take
Yeah.
notes. Write that down.
Right. Brian's full of wisdom.
So we have that conversation. We lock your terms. Most likely, you may say, hey, you know what? I think some inflation numbers coming out later this week, and that's going to make rates go lower. Okay, if you want to float, you can float. If you want to lock, we'll lock. At the end of the day, it's your choice.
The old gambler.
Yeah.
Yeah.
How do you want to approach this? The old adage that I always hear, the girl I work with, Belinda Arender, she always says, pigs get fed, hogs get slaughtered.
Whoa. Super accurate.
Yeah.
Super accurate.
So it's
That's so Belinda.
Yeah,
It
she
is.
is. What a legend.
So then we're going to send you some disclosures so that you can see everything. That's the loan estimate part of things. And that's an important piece of the transaction. It's an important step for you to make sure that your lender's not trying to get crazy and stick anything by you, like a whole lot of points that you didn't really realize were going to be there. I had one come over to me 2 or 3 weeks ago where she saw the loan estimate and she was like, this doesn't feel right. My closing costs shouldn't be that much. And we took a look at it, and then, my gosh, I'm not going to get into the details of how much money we saved her, but let's just say it was significant.
Yeah.
It was really a significant savings for her. And
that's, you just got that. Yeah. You got to know your people.
Yeah.
Work with trusted relationships, right?
I'll say this: work with somebody local.
Yep.
In this case, it wasn't a local company that she had been working with. Like I said, we have a lot of good lenders in our area locally. Find somebody local.
That's huge.
That if you see them around town, they're not going to try to duck into the next grocery store aisle, because they're going to be happy to see you. They're not,
that's right.
Trying to hide from you.
That's huge. So where were we?
That when my introvert.
Yeah. Social quota's been met.
Yeah.
You're like, okay.
I'll catch up with you next time. No, we've all been there. All right. So where were we? Got the rate. We got the disclosures. Yeah.
We're gonna most of the time, most lenders are going to have you go ahead and pay for the appraisal up front. You're going to get with your realtor and set up your inspections. This is kind of your due diligence period where we're determine, make sure there's a fair value on the home, making sure that the home is in good condition. And then I'm going to that's all I'm going to say about the real estate side of it. Okay. Jonathan would be able to, or any realtor would be able to go into that part of it. I want to stay focused on the mortgage side.
Yep.
So once the appraisal comes in, we know if it's made value, then we proceed. If it's, we don't send the value and a copy of the appraisal report to the listing agent. So if you're under contract for 400,000 and the price is for 425, congrats on your equity. They're not going to know that, because we don't want them to ask you to pay more for the house or come up with some negotiation thing. Now, if it's a little low, let's say it only prices for 375 instead of 400, then you're going to go back to the negotiation table. And we're going to, if we need to dispute if everybody agrees that 400 was the right price, then we'll look at the comps the appraiser used, and we'll see if they made sure they measured the home right for the correct square footage, and go through all that process. And at some point, usually while we're waiting for that appraisal to come back in, we're going to get conditional approval from underwriting.
Right.
And so what conditional approval means is that the underwriter has reviewed all of the documents that the loan officer has obtained and said, I've signed off on your income, but I want you to get a verification of employment on the previous employer, just to find out the dates that they worked there, or there's a large deposit in a bank account statement that we need to explain. They're going to look through it and make sure that if they have any questions, they'll come back to it with those questions. Our processor is going to work through those conditions, and a lot of times it's like, hey, you got to shore up the homeowner's insurance because that hasn't been determined yet who you're going to use, or there's a previous address on your credit report. Can you tell us if you ever lived at XYZ, Main Street?
Sure.
Or maybe there's an inquiry on your credit report because you were shopping for a mortgage.
Right.
And so, hey, did you get a mortgage with this other bank? Or maybe there's a card loan inquiry or credit card inquiry. And if there is, then we got to find out, did you open up another account that's not reflected on your credit report yet? Because that could affect that debt to income ratio. And then once we satisfy all those conditions, we just work through your loan officer and your processor, maybe a loan officer assistant to turn in everything else that's asked for. We get that clear to close, baby.
Let's go. C to C, baby.
And then you just make arrangements with your title company and your lender to bring your down payment or closing costs to the closing table, and how you're going to do that through a wire transfer or an official check, and sign the papers.
I love that, man.
It's really not that complicated.
Right.
Bryan makes it sound
I know. There's nothing to it. Nothing to
it's no big deal. Just do it.
Sometimes those conditions can be tricky, but a lot of times it's just, we're smooth sailing.
I love that.
Yeah.
I feel like we've done a good job demystifying.
For sure.
It's a fun word. Yeah. I'm probably going to try to start using it more often.
Yeah.
I
and
feel like
I love
demystifying something.
And I love this podcast today specifically because, like, I would fit into a first-time home buyer situation.
Right.
And this has been a great learning opportunity. I mean, a lot of it I already knew, but like it was good to hear from your vantage point. Yeah. So
you did great, man. It's always we really appreciate you over here at J Harmon Home Team, man. Spread the positive. Thank you, man, for everything you do. any final thoughts? Anything else we forgot or anything like that?
Oh man, I should have prepared like a big long paragraph filled with Taylor Swift references.
Man, that would have been
Yes.
pretty
Those
fun.
newscasters are doing it. So
Oh,
yeah,
yes.
Oh,
the
yeah,
weather
that would-
reports.
Got a blank
No, there's
space.
no bad
Are you
blood here.
feeling 22?
we could go off the cuff with
Oh,
it.
I've got Taylor Swift references. I've got
Got a blank
lyrics. You
space to
just let me
fill
know
out
what
a
you want.
disclosure. I don't know.
You don't want to have
That's-
any bad blood between you and
No.
your realtor or your lender.
You're the man.
That's right. All right, y'all. Well, this has been This Week in Real Estate. As always, be sure to check out the J Harmon Home Team at all of our socials, jharmonhometeam.com. Bryan is with Primis Mortgage. Plug away. Where can people find you?
So you can go to nailyourmortgage.com, or
go.
you can always just shoot me a text. I only carry one phone. I don't have a work phone. I don't have a private phone. It's 615-243-3976. You can call, you can text. I answer the phone. And so if I can help in any way, just please let me know. Nailyourmortgage.com is that website.
That's such a good slogan. Love it so
It
much,
is.
man.
Yeah.
Well, appreciate you. Seriously, Bryan. Thank you for all you do. And we'll wrap this one up. Peace out.